Okay.
Hello and welcome to Business Today Television. I am Siddharth Zarabi and with me today Madan Sabnavis, the Chief Economist at the Bank of Baroda. Thank you very much, Madan, for joining us on the show today. We call it Easynomics, where we try and demystify matters related to high macroeconomics and high finance as well. So on today's show, I'm going to ask you to start by telling our viewers about what this special meeting of the Monetary Policy Committee is all about. When it was announced for a brief period of time, there was some amount of speculation that is another rate hike coming, but then it became clear through the text of the announcement that this was with a different purpose. So set the context for what is being discussed by the MPC today.
Yeah, thanks, Siddharth. You're right. When they did make the announcement that there would be an MPC committee meeting, even we did feel that there would be some deliberation on interest rates. And it came as a relief that, especially for the markets, that it had nothing to do with interest rates, but with something more fundamental about the way in which the MPC operates. Now, here it'll be interesting to go back to 2016 when the MPC was formulated. At that particular point of time, it was felt that the MPC should also be responsible for whatever happens in terms of the policy stance that is taken by the committee and the impact it has on economic variables, especially inflation. So the MPC mandate had said very clearly that the committee had to target an inflation rate of 4%. There was a band of 2% on either sides, which was kept open, which means that inflation had to be between 2 and 6% for all times. And in case inflation was above 6% for a protracted period of time, and now it's been so for 9 months, then it was felt that the RBI is answerable to the Parliament, and therefore the RBI will have to provide an explanation as to why is it that inflation has been so high, what is it that the RBI has done in order to control inflation? And lastly, as to at what point of time or how much of time would be taken before we get back on the right path of inflation. So that was basically the mandate which was there when the MPC was formulated. And as we all know, the MPC has 3 members from the RBI and there are 3 outside experts, all economists from the academic world or from anywhere else. And therefore, it's a joint decision which is taken. So I think the deliberations was essentially as to what should go into that particular letter, because this is something which becomes legislative in nature, in the sense that RBI writes to the government, it has to be presented to the Parliament, where you actually explain as to why is it that inflation has been so high and what are the steps which the RBI has taken and will probably be taken, in order to control inflation. And since we're talking of a letter from the RBI, necessarily you have to call the MPC to deliberate as to what should be the content.
Okay, would I be correct in saying that this is largely a procedural meeting, or should I be asking you about the fact that this is perhaps the first time such a meeting and such a reply is going from the MPC RBI to the government? Does it represent a failure of the MPC to control inflation?
See, actually, Siddharth, it's a combination of both. It's actually a procedural thing because I would not be reading too much into what's going to be the final outcome in terms of what the RBI writes and how the government reacts. But it'll be interesting to see as to what exactly the RBI would be mentioning in the letter, because I don't think in any other country we see the central bank being held responsible in this particular manner, that you're actually answerable as to why inflation has not been brought under control. So therefore, I think the content of what the RBI writes, which again, I think is very logical for one to conclude that we all know why inflation was high, why monetary policy did not work. So I think we all know what will happen, but I think that's what the entire process is. So therefore, it's procedural, but at the same time, fairly unique.
Would I also be correct in asking you that does this exercise reek of a situation where the fiscal authority, the political authority, the lawmakers seem to be, at least in the public eye, putting all the blame on the RBI for inflation control, when we know that inflation in India is not just a monetary phenomenon?
No, that's right, because I'm quite sure that when the RBI gives its reply, it will say that it has done everything that can be done, and it's still doing what it has to do, because the RBI only has one particular tool to use, which is the repo rate. And once it was convinced that growth was stable, then it started increasing rates. It has been doing so quite relentlessly. But I'm quite sure that they will also mention that when you're giving the causes of inflation, that the effect of taxation, for example, we have seen the GST, which was extended to other commodities, to essential commodities. We have seen that the states have not been responding in terms of lowering their tax rates on fuel products, and that has sort of fed into this entire inflationary spiral. So I'm quite sure that the RBI will mention this, though maybe not directly, but they will definitely give what else has to be done in order to control inflation. And definitely, to my mind, I would agree with you that it's a joint decision, it's a joint control which has to be taken by the government and the RBI, because monetary policy can work only to a certain extent.
Madan, I will try and do this in a rapid fire manner. Question number one, inflation control in the current dynamic. The government has not passed on the changes in crude oil prices. Pump level prices of petrol and diesel have been frozen for several months now. Would it be right to say that the current set of inflation data that we are seeing is artificially depressed, and actually inflation, at least in terms of the headline number, would have been far higher had the government acted true to the mandate of allowing petrol companies to change rates every day?
Yeah, absolutely. Because I think the prices have been kept down at the present level. But we should also remember, Siddharth, when the prices came down, the crude oil price came down, at that point of time, we did not reduce the retail prices. So I think on the whole, there would be some kind of a balance which takes place over a period of time. But at this particular moment, when we are saying that the price of international price of crude oil is going up, you're definitely not increasing the prices. The OMCs are taking a hit on that. And I think the government is also compensating the OMCs on discount, especially on the LPG side, not exactly on the petrol and diesel side, but that kind of cross subsidization has definitely taken place.
Okay, do you think this is good, this kind of cross subsidization? Because the whole idea of a free market principle to operate in fuel prices was to ensure that there are no sudden decisions and reversals of the kind that we are talking about.
No, I don't think it's a good idea to leave everything free to the market, because when the price of crude oil came down during the pandemic times, then logically the price of petrol and diesel had to also be brought down to absurdly low levels, which was not done. So I think the way in which the entire oil economics works, it defies market principles. It's all based in terms of how do you take care of different constituencies. One is the government, second is the OMCs, the third is the consumer. So I think that is why we have fairly illogical solutions out here. So the outcomes which happen are not something which are always predictable, because always there's one segment which feels that they are bearing the burden of the other two. So I think we should... Yeah.
And the consumer comes last and has to fork out money from both pockets.
Yeah, logically that always happens, because if you look at the OMCs, they are the companies which are actually owned by the government, and in case they do well, they earn profits. The profit actually comes back to the government in the form of non-tax revenue. Whereas when you're talking of consumers, I think it's generally felt that a large part of the consumer population can bear the cost. And at one point of time, we felt the price of petrol would never cross 100, but we also continued paying 120. Now maybe it's come down. So I think consumers only probably complain a lot, but they do not do anything else. So therefore, the consumers can be made to pay a higher price. OMCs cannot. The government is bothered about the fiscal deficit. So therefore, I think the burden does fall on the consumer finally.
Okay, let's move on from the political economy questions that I have just subjected you to, but it was necessary to do so, perhaps to set the context of this extraordinary unscheduled meeting of the MPC. As you have explained to our viewers, and to recap what you have said at this stage, It's in some ways procedural, but it's also significant. The RBI will formally tell the government and therefore Parliament what were the reasons that inflation has stayed beyond the targeted mandate and mention that has been done when the policy and the committee was formed. Let's move on from here. Madan, the festive season is behind us. The monsoon related impact on certain segments of the price basket is also behind us. A new crop is.
The inflation number, which is always calculated in terms of percentage change over the past, will probably trend downwards. So that's something which we'll see, which will give a lot of comfort to the RBI that the inflation numbers are coming down. However, if we are looking in terms of overall prices, I think those price pressures will remain. And as we have said, the fuel prices are not going to come down, even in case the crude oil price comes down. And we have seen that prices of food products, something like rice, pulses, they're going to continue to increase because the Kharif crop wasn't really optimal. We have seen vegetable prices going up. So I think on the food side, I think prices are going up. And I think that's going to be a possible threat for us for the overall price scenario. But the inflation scenario will definitely keep getting better. And I would not be surprised if by the end of March, we would be ending at something closer towards 5.5% in terms of
And,
inflation.
okay, now since you mentioned that number as the rate of inflation as measured by the consumer price index, I want to ask you, what will it mean for the average Aam Aadmi borrower in India? We have seen that interest rates have headed up in India and it works both ways. On one hand, savers are getting slightly more on their money deposits, on their savings, while as there is a significant impact on borrowers. What is going to happen from here on? All right, I think we will try and get Madan Sabnavis back online. There seems to be a bit of a problem as far as the digital connectivity is concerned. But as we try and reconnect with Madan Sabnavis, I just want to recap. And Madan is back with us.
Can you come in? Yeah.
Yes, Madan, if you heard my question,
Yeah, I heard you. I heard you.
Go ahead, tell us.
Yeah, so we're actually saying that as interest rates keep moving up, I think the savers will definitely be better off because we've had a situation for the last 2 or 3 years where interest rates were very low, something which militated against financial savings. Now that kind of a thing is going to get reversed. However, in case you are a borrower, especially if you're a home borrower, I think they're the ones who are going to get affected the most because most of the home loans have been benchmarked against the repo rate. And if the repo rate is going to go, it's already gone up by 190 basis points. Let's assume we go to 6.5%. Then automatically we'll see that compared to March, you will be paying 250 basis points higher than the repo rate. Your cost has gone up. EMIs are going to get protracted. So it's going to be affecting consumers in a differential manner depending upon whether you're a saver or borrower. But on the whole, I would say that the happy days of low interest rates were not going to last for all times. And this is a major correction which is taking place. Hopefully, it's a kind of a gradual one which we are seeing and something which can be absorbed by the household community.
Madan, interest rates are cyclical in nature, and while there is considerable amount of theory and real data, historical data that we can discuss, I want you to tell our viewers that what is the new cycle going to look like? The golden age or the golden days of low interest rates being behind us. And by the way, viewers, it's not just in India, where I personally have always argued that money is amongst the most expensive when it comes to the rate of borrowing anywhere in the world, and at least for a growing economy like India. It's the United States, where the US Fed has just literally hours ago undertaken yet another interest rate hike in order to cool inflation. So, how long will this new paradigm last, Madan?
See, the way I look at it is that the RBI will be looking in terms of a positive real interest rate. So I think we need to keep in mind what exactly is this positive real interest rate. So depending upon where the inflation number, because we're going to go statistically by what the CPI inflation number shows. So in case we're talking of a CPI inflation number of say 5%, I think a repo rate in the region of around 5.756% looks to be something which would be tenable for over the medium term, and that's what we have to be prepared for. Now, in case inflation does come down for some reason to less than 5%, we go back to the 4.5% days, which was of course rare. Then we could really think of interest rates coming down further to maybe something like 5.5%. There's just a kind of a thumb rule saying that you need to have a 1% return. Maybe you could go for something like half to 1%, half to 75 basis points. That would be a call which the RBI would take. But broadly speaking, I think look at the inflation rate, look at what the repo rate is, and make an adjustment of around 50 to 100 basis points. That would be the kind of an interest rate scenario which we could be looking at. And I think that's what the RBI is going to target, because I think now the talk is also in terms of what the real interest rate should be like. And that could be the future driving factor for RBI policy.
One of the other things that is being mentioned is this term or phrase, the age of inflation. It's being argued by some economists, and I want to know your view on this, especially from the Indian context, that the advanced economies, countries like the United States, the United Kingdom, the Eurozone, pretty much most of the world is now headed for a prolonged era of a higher rate of inflation for perhaps the next few years. And I hesitate in even saying that next few years because I haven't seen precise forecasts. Madan, what's your own view on this?
See, globally, I think the inflation rate is definitely not going to be 2%. I think they will be looking at a number from 3 to 4%. Now, that said, I think as far as India is concerned, India is a country which typically has an inflation rate of about 5%. So I've always had a different view on terms of targeting 4% inflation for India, because I think for a developing economy like India, where the CPI index has a large component of food items, and the food items themselves tend to be very, very whimsical, because we always have onion shocks, tomato shocks, potato shocks, something which could be driving up inflation almost every year. The pattern of monsoons has changed. A delayed monsoon destroys certain crops, especially the horticulture area. So, therefore, I think when we're talking of inflation, we need to be a bit more pragmatic when we're looking at an inflation number. So, a country like India, I think 5 to 6% inflation is a kind of a normal inflation. It also provides the right kind of a stimulus for industry to produce. Because if we're going to have inflation, the WPI of manufactured products, say in the region of 1 to 2%, which we had for a long period of time before the pandemic, it does not actually make companies want to produce more. You lose your pricing power. So there's a minimum amount of inflation which is required, which to my mind, manufacturing 3 to 4%, aggregate 5 to 6%, which is bearable in India. Our economy cannot really be compared with those of the Western ones, which are more evolved. They are less prone to these kind of shocks. They're driven more by the demand side factors. You see, the recovery in the economies can lead to commodity prices going up, whereas India is a price taker for most of these commodities, or we are dependent upon agriculture, which is totally domestic in nature. So I think we need to distinguish between the two of them, but definitely for sure, I think higher inflation is bound to stay across the world, all regions, at least for the next 2 years.
That's a good point, and I completely agree with you. And this is something that we have discussed in the past. And I would go to the extent of saying that perhaps, along with the reply that Shaktikanta Das and his team gives on behalf of the MPC and the RBI, there should also be an argument that political expectations around the headline management as far as the inflation number is concerned, those need to be reset. Perhaps the entire act needs to be relooked. Some of the clauses need to be redrafted, keeping in mind the realities and needs of India. I want to take a couple of points as we wind down this conversation. One of the bigger worries, and that keeps coming up, is the bit about the interest rate differential, which impacts money flows and inflows, especially the portfolio part of it, into the Indian stock markets. Many people would say that the Indian stock markets are divorced from some of what is happening as far as the macro is concerned. But what's your view as far as the interest rate differential is concerned? And do you have a view on the likely impact as far as inflows are concerned, at least if not in December, but from January, once the Western world comes back fully into business?
Actually, Siddharth, I was looking at some of these FPI numbers, saying the total amount of assets under custody for the FPIs. And you see what part of it is coming into equity and what part into debt. You'll realize around 85 to 90% is actually in equity. So while we make a lot of ado about the fact that these interest rate differentials keep affecting what happens in the debt segment, there was quite a bit of euphoria about when we spoke about Indian bonds being included in global bond indices. But at the end of the day, if you see most of the FPI seems to be going into the equity segment rather than the debt segment. And even for the debt segment, it's more towards the government securities rather than to corporate bonds because of various reasons. We know the corporate bond market is not that well developed. Exit is difficult. So let's not really get into those issues. So this being said, when we are talking of interest rate differentials, to my mind, I think the way I look at it is that globally, we're looking at the Federal Reserve, we're looking at the ECBs. What they're doing is they're increasing rates and they've also gone into quantitative tightening. And I think that's the more important factor. When I do tightening, I think the buyback of bonds, which were there earlier in very large quantities, I think that's something which has actually been pushed aside. So we have a smaller quantum of investable funds which are available to the investors. And that's the reason why we're seeing continuously a kind of a withdrawal which is taking place because you're juggling around with a fixed amount of funds which are there. 10 new funds which are really coming in. I think that is the larger picture. The second part, of course, is that the Indian market has been performing better than the global markets. And that's one of the reasons why we're seeing that in equities, especially in the month of, I think, July and August, we had seen positive flows. Subsequently, of course, we moved into the negative terrain. So I think interest rates, I would look at it in a more broader sense of saying the overall tightening which is taking place in the global economy. That is something which is really impacting the overall flow of funds, not necessarily just the Federal Reserve increasing rates to from 3.25 to say 4%.
Absolutely. And one key point as we close this conversation that I want to remind our viewers about, and this is a subject that we had covered on the show earlier, which is the point that Madan made earlier during this conversation about shocks when it comes to prices. For example, onions, which are a highly politically sensitive matter. This year production is down, yet prices are likely not to rise as much, at least to cause a political sort of turmoil around it, because there is adequate supply that is already there in the market. So inflation in some ways in a market and economy like India is subject to far more external changes than in the advanced economies. My final question really, Madan, today is beyond this extraordinary meeting, what do you expect the MPC to do in its next meeting in December? Another hike on the cards, or pause at least for a few months?
No, I think there will definitely be a hike in interest rates, even though we're expecting the inflation number, which will be the next reading which the RBI will have for the month of October, to be less than 7%, maybe around 6.75, 6.8% is what we're looking at. But given the fact that the RBI has alluded to three shocks in the earlier policy, they spoke of COVID, they spoke of Ukraine, and they spoke of what the Federal Reserve is doing. And given the fact that there is a formal letter which is going from the RBI on behalf of the MPC to the government on inflation, I think it logically follows that they will continue increasing rates. Of course, the question will be whether it will be 25, 35 basis points or another 75 basis points. I think that remains to be seen. I would tend to think it will be a bit more modest at 25, 35 basis points in the December policy.
Well, that would be the hope of many participants in our economy, that interest rates don't go up too much and inflation remains stable and doesn't rise too much. But that's the impossible trinity that is a subject in economics that Manmohan Singh always used to mention, that inflation, which is one of the worst taxes on the poor, and managing that impossible trinity is a big challenge. That's what the RBI is doing. That's what North Block is also trying to do. And hopefully there will be light at the end of this tunnel. Madan Sabnawis, as always, thank you very much for your time. It's been a pleasure talking to you. And with that, it's a wrap on this episode of Easynomics. We'll be back with more. Stay with us and stay tuned in. Goodbye.